The best way to invest money depends on your personal financial goals, risk tolerance, and time horizon. Here are some popular investment options. 1. Stocks. Equities offer potential for long-term growth but can be volatile. 2. Bonds. Fixed income investments provide regular income and relatively lower risk. Real estate investing in property or REITs can offer rental income and appreciation. Mutual funds. Diversified portfolios managed by professionals. Exchange-traded funds, ETFs, similar to mutual funds but trade on an exchange like stocks. Index funds track a specific market index like the Nifty 50 or sensex. Diversification means spreading investments across asset classes to minimize risk. Rupee cost averaging is about investing a fixed amount regularly, regardless of market conditions. Long-term approach. Resist short-term market fluctuations and focus on long-term growth. Low-cost investing. Opt for low-fee investment options. Professional advice. Consult a financial advisor for personalized guidance. Education. Continuously learn about investing and stay informed. Discipline. Stick to your investment plan and avoid emotional decisions. Stocks, also known as equities, are a type of security that represents ownership in a company. When you invest in stocks, you're essentially buying a small portion of that company's assets and profits. Pros of investing in stocks. 1. Potential for long-term growth. Stocks have historically provided higher returns over the long term compared to other investment options. 2. Liquidity. Stocks can be easily bought and sold on stock exchanges. 3. Ownership. As a shareholder, you have a claim on a portion of the company's assets and profits. 4. Dividend income. Many stocks pay dividends, which can provide a regular source of income. Cons of investing in stocks. 1. Volatility. Stock prices can fluctuate rapidly and unpredictably, resulting in losses if sold during a downturn. 2. Risk companies can go bankrupt, wiping out your investment. 3. Lack of control. As a shareholder, you have limited control over the company's operations. 4. Market and economic factors. Stocks are affected by various market and economic factors, such as interest rates, inflation, and geopolitical events. To mitigate these risks, it's essential to 1. Diversify. Spread your investments across various asset classes, sectors, and geographies. 2. Set clear goals. Define your investment objectives and risk tolerance. 3. Invest for the long term. Ride out market fluctuations and focus on long-term growth. 4. Stay informed. Continuously educate yourself on investing and market trends. Remember, investing in stocks requires a well-thought-out strategy, patience, and discipline. Bonds are a type of fixed income investment that represents a loan made by an investor to a borrower, typically a corporation or government entity. In exchange for the loan, the borrower agrees to make regular interest payments and return the principal investment at maturity. Pros of investing in bonds. 1. Regular income. Bonds provide regular interest payments, which can be attractive for income-seeking investors. 2. Relatively lower risk. Bonds are generally considered lower risk compared to stocks, as they offer a fixed return and a higher claim on assets. 3. Predictable returns. Bond returns are typically more predictable than those from stocks. 4. Diversification. Bonds can help diversify a portfolio by reducing dependence on stocks. Cons of investing in bonds. 1. Lower returns. Bond returns are generally lower than those from stocks, especially over the long term. 2. Credit risk. The borrower may default on interest or principal payments. 3. Interest rate risk. Changes in interest rates can affect bond prices and yields. 4. Liquidity risk. Some bonds may have limited liquidity, making it difficult to sell them quickly. Types of bonds. 1. Government bonds, for example, U.S. Treasury bonds. 2. Corporate bonds. 3. Municipal bonds, which are issued by local governments or entities. 4. High-yield bonds, offering higher yields to compensate for higher credit risk. 5. International bonds, issued by foreign governments or corporations. When investing in bonds, consider 1. Credit quality. Assess the borrower's creditworthiness. 2. Yield. Evaluate the bond's yield in relation to its credit quality and market conditions. 3. Duration. Consider the bond's maturity and sensitivity to interest rate changes. 4. Diversification. Spread your bond investments across various types and issuers. Remember, bonds can be a valuable addition to a diversified investment portfolio, offering relatively stable income and lower risk. Index funds are a type of mutual fund that tracks a specific market index, such as the Nifty 50. Here's a summary. Benefits. 1. Diversification. Index funds provide instant diversification by tracking a broad market index. 2. Low costs. Index funds are often less expensive than actively managed funds. 3. Consistency. Index funds tend to be less volatile than individual stocks or actively managed funds. 4. Long-term performance. Index funds have historically provided strong long-term performance. 5. Simplicity. Index funds offer a straightforward investment approach with no need to pick individual stocks or try to time the market. Considerations. 1. Limited upside. Index funds may not perform as well as actively managed funds during market upswings. 2. No flexibility. Index funds are tied to a specific index, so investors can't adjust the portfolio composition. 3. Risk. Index funds carry the same risks as the underlying index, such as market volatility. Popular types of index funds. 1. Nifty 50 index funds. Track the Nifty 50 index, comprising the top 50 Indian stocks. 2. Sensex index funds. Track the sensex index, comprising the top 30 Indian stocks. 3. Total stock market index funds. Track a broad market index, such as the Wilshire 5000. 4. Sector index funds. Track a specific sector, such as technology or healthcare. 5. International index funds. Track a global market index, such as the MSCI EFE. To get the most out of index funds, 1. Understand the underlying index. Be aware of the securities and weightings within the index. 2. Set clear goals. Determine your investment goals and risk tolerance. 3. Diversify across asset classes. Spread investments across different asset classes, such as stocks, bonds, and real estate. 4. Consider a long-term approach. Index funds are suitable for long-term investors. 5. Monitor and adjust. Regularly review your portfolio and rebalance as needed. Remember, index funds offer a low-cost, diversified way to invest in the market, but it's essential to understand the underlying index and risks involved. Exchange-traded funds, or ETFs, are a popular investment vehicle that combines the benefits of mutual funds and stocks. Here's a summary. Benefits. 1. Flexibility. ETFs can be traded throughout the day, allowing investors to quickly respond to market changes. 2. Transparency. ETF holdings are disclosed daily, so investors can see exactly what they own. 3. Diversification. ETFs offer a wide range of asset classes, sectors, and geographic regions to help spread risk. 4. Tax efficiency. ETFs are generally more tax efficient than mutual funds due to their pass-through tax structure. 5. Low costs. ETFs often have lower expense ratios compared to actively managed mutual funds. Considerations. 1. Trading costs. Investors incur brokerage commissions when buying and selling ETF shares. 2. Market risk. ETFs are subject to market fluctuations, which can result in losses. 3. Liquidity risk. Some ETFs may have limited liquidity, making it difficult to buy or sell shares quickly. 4. Underlying holdings. Risk. ETFs hold underlying securities, which can carry their own risks. Popular types of ETFs. 1. Index ETFs. Track a specific market index, such as the S&P 500. 2. Sector ETFs. Focus on a specific industry or sector, like technology or healthcare. 3. Bond ETFs. Invest in a diversified portfolio of bonds. 4. Commodity ETFs. Track the price of a specific commodity, such as gold or oil. 5. Actively managed ETFs. Employ a professional manager to actively select securities. To get the most out of ETFs. 1. Understand the underlying holdings. Be aware of the securities held within the ETF. 2. Monitor and adjust. Regularly review your ETF holdings and rebalance your portfolio as needed. 3. Consider a long-term approach. ETFs can be a good fit for long-term investors. 4. Diversify across ETFs. Spread investments across different asset classes and sectors. 5. Keep costs in mind. Be mindful of trading costs and expense ratios. Remember, ETFs offer a flexible and transparent way to invest in a broad range of assets, but it's essential to understand the underlying holdings and risks involved. Mutual funds offer a convenient way to invest in a diversified portfolio of stocks, bonds, or other securities, managed by experienced professionals. Here are some benefits and considerations. Benefits. 1. Diversification. Mutual funds provide instant diversification, reducing risk by pooling funds from multiple investors to invest in a variety of assets. 2. Professional management. Experienced fund managers actively monitor the market, make investment decisions, and adjust the portfolio as needed. 3. Convenience. Mutual funds offer a hassle-free way to invest in a broad range of assets, with minimal effort required from individual investors. 4. Economies of scale. Mutual funds can take advantage of lower trading costs and other economies of scale due to their large asset base. 5. Regulatory oversight. Mutual funds are subject to strict regulations and disclosure requirements, providing an added layer of security for investors. Considerations. 1. Fees and expenses. Mutual funds charge management fees, administrative costs, and other expenses, which can eat into investment returns. 2. Risk. Mutual funds can still carry risk, as the value of underlying securities can fluctuate. 3. Lack of control. Investors have limited control over the portfolio composition and management decisions. 4. Tax implications. Mutual fund distributions can trigger tax liabilities for investors. 5. Performance variability. Fund performance can vary significantly depending on market conditions, manager expertise, and other factors. To navigate these considerations, it's essential to 1. Research and select. Choose funds with a strong track record, experienced managers, and low fees. 2. Understand the investment strategy. Be aware of the fund's investment objectives, risk profile, and asset allocation. 3. Monitor and adjust. Regularly review your mutual fund holdings and rebalance your portfolio as needed. 4. Consider tax implications. Factor in tax implications when investing in mutual funds and aim to minimize tax liabilities. 5. Diversify across funds. Spread investments across different mutual funds and asset classes to minimize risk. Remember, mutual funds can be a valuable addition to a diversified investment portfolio, offering convenience, professional management, and access to a broad range of assets. Diversification is a key investment strategy that involves spreading investments across different asset classes to minimize risk. By diversifying, investors can reduce their exposure to any one particular asset class, sector, or geographic region, and increase their potential for long-term success. Benefits of diversification. 1. Risk reduction. By spreading investments across different asset classes, investors can reduce their risk and increase their potential for long-term success. 2. Increase potential for returns. Diversification can help investors increase their potential for returns by investing in a variety of assets that perform well in different market conditions. 3. Improve stability. Diversification can help investors improve the stability of their portfolios by reducing their exposure to any one particular asset class or sector. 4. Enhanced flexibility. Diversification can provide investors with the flexibility to adjust their portfolios as market conditions change. Ways to diversify. 1. Asset allocation. Spread investments across different asset classes, such as stocks, bonds, real estate, and commodities. 2. Sector diversification. Spread investments across different sectors, such as technology, healthcare, and financials. 3. Geographic diversification. Spread investments across different geographic regions, such as the US, Europe, and Asia. 4. Style diversification. Spread investments across different investment styles, such as growth, value, and dividend investing. Best practices for diversification. 1. Start with a solid core. Establish a solid core of diversified investments, such as a broad-based stock fund or a total bond fund. 2. Add satellite investments. Add satellite investments that complement your core holdings and provide additional diversification. 3. Monitor and adjust. Regularly monitor your portfolio and adjust as needed to maintain an optimal asset allocation. 4. Avoid over-diversification. Be mindful of over-diversification, which can lead to increased costs and reduced returns. By following these best practices and maintaining a diversified portfolio, investors can increase their potential for long-term success and reduce their risk. Rupee cost averaging, or RCA, is a popular investment strategy that involves investing a fixed amount of money at regular intervals, regardless of the market conditions. This strategy helps reduce the impact of market volatility and timing risks, and can be an effective way to invest in the stock market. Benefits of rupee cost averaging. 1. Reduces timing risk. By investing a fixed amount regularly, you'll be buying more units when the market is low, and fewer units when the market is high. 2. Averages out market fluctuations. RCA helps smooth out market ups and downs, reducing the impact of volatility on your investments. 3. Encourages disciplined investing. Investing a fixed amount regularly helps you invest consistently and avoid making emotional decisions based on market conditions. 4. Long-term focus. RCA helps you focus on long-term goals and avoid worrying about short-term market fluctuations. How to implement rupee cost averaging. 1. Decide on a fixed amount. Determine how much you want to invest each month or quarter. 2. Choose an investment interval. Decide on a regular interval to invest, such as monthly or quarterly. 3. Select an investment option. Choose a mutual fund, ETF, or stock that aligns with your investment goals. 4. Automate your investments. Set up a systematic investment plan, or SEP, or automate your investments to make investing easier and less prone to emotional decisions. 5. Monitor and adjust. Periodically review your investments and rebalance your portfolio as needed to maintain an optimal asset allocation. Example of rupee cost averaging. Suppose you invest 1,000 rupees every month in a mutual fund. When the market is high, your 1,000 rupees might buy 10 units. When the market is low, your 1,000 rupees might buy 20 units. Over time, you'll have averaged out the market fluctuations and accumulated a decent number of units. Remember, rupee cost averaging is a long-term investment strategy that requires patience and discipline. By investing regularly and systematically, you can reduce the impact of market volatility and work towards your long-term financial goals. A long-term approach to investing involves resisting short-term market fluctuations and focusing on long-term growth. This approach is essential for achieving financial goals, such as retirement, education, or wealth accumulation. Here are some key aspects of a long-term approach. 1. Time horizon. A long-term approach typically involves a time horizon of 5 years or more. This allows investors to ride out market fluctuations and avoid making emotional decisions based on short-term market movements. 2. Growth focus. Long-term investors prioritize growth over income or capital preservation. They seek to maximize returns over the long term, even if it means taking on more risk. 3. Dollar cost averaging. Long-term investors often use dollar cost averaging to reduce the impact of market volatility. This involves investing a fixed amount of money at regular intervals, regardless of the market's performance. 4. Patience. A long-term approach requires patience and discipline. Investors must resist the temptation to try to time the market or make impulsive decisions based on short-term market movements. 5. Regular monitoring. While long-term investors avoid making emotional decisions, they still need to regularly monitor their portfolios to ensure they remain aligned with their goals and risk tolerance. 6. Rebalancing. Long-term investors may need to rebalance their portfolios periodically to maintain an optimal asset allocation. 7. Tax efficiency. Long-term investors should consider the tax implications of their investments and aim to minimize tax liabilities. 8. Risk management. Long-term investors should have a well-thought-out risk management strategy to protect their portfolios from potential downturns. By adopting a long-term approach, investors can 1. Reduce stress. By focusing on long-term growth, investors can reduce their stress levels and avoid making impulsive decisions. 2. Increase returns. Long-term investors can potentially earn higher returns by riding out market fluctuations and avoiding frequent buying and selling. 3. Achieve financial goals. A long-term approach helps investors stay focused on their financial goals and make steady progress towards achieving them. In summary, a long-term approach to investing involves resisting short-term market fluctuations, focusing on growth, and prioritizing patience, discipline, and regular monitoring. By adopting this approach, investors can increase their potential for long-term success and achieve their financial goals. Low-cost investing is a smart strategy that involves opting for low-fee investment options to minimize expenses and maximize returns. Here are some ways to achieve low-cost investing. 1. Index funds. Invest in index funds, which track a specific market index such as the S&P 500. Index funds have lower fees compared to actively managed funds. 2. Exchange-traded funds or ETFs. ETFs are similar to index funds but trade on an exchange like stocks, offering flexibility and low fees. 3. Discount brokerages. Use discount brokerages that offer low commissions and fees for buying and selling securities. 4. No-load mutual funds. Invest in no-load mutual funds, which don't charge sales loads or commissions. 5. Low-cost investment apps. Utilize investment apps that offer low fees, such as Robinhood or Fidelity. 6. Avoid high-fee investments. Steer clear of investments with high fees, such as hedge funds or private equity. 7. Monitor and adjust. Regularly review your investment portfolio and rebalance as needed to maintain an optimal asset allocation. Benefits of low-cost investing. 1. Higher returns. By minimizing fees, you can potentially earn higher returns over the long term. 2. Increased efficiency. Low-cost investing helps you make the most of your investment dollars. 3. Reduced stress. With lower fees, you'll have less stress and more peace of mind. 4. Greater flexibility. Low-cost investing provides the flexibility to adjust your portfolio as needed. Remember, low-cost investing is a long-term strategy that requires discipline and patience. By opting for low-fee investment options and minimizing expenses, you can potentially achieve higher returns and reach your financial goals. Consulting a financial advisor can provide personalized guidance and expert advice tailored to your specific financial situation and goals. Here are some benefits of seeking professional advice. 1. Customized guidance. A financial advisor will assess your individual circumstances, risk tolerance, and objectives to provide tailored recommendations. 2. Expert knowledge. Financial advisors possess in-depth knowledge of financial markets, instruments, and regulations, ensuring you receive informed guidance. 3. Objective perspective. A financial advisor can help you avoid emotional decision-making and provide an objective view of your financial situation. 4. Comprehensive planning. Financial advisors can help you develop a comprehensive financial plan, addressing multiple aspects of your financial life. 5. Access to a network. Financial advisors often have a network of professionals, such as attorneys, accountants, and insurance specialists, to provide additional expertise. 6. Ongoing support. A financial advisor can provide ongoing support and monitoring, helping you stay on track with your financial plan. 7. Accountability. Working with a financial advisor can help you stay accountable and motivated to achieve your financial goals. When seeking professional advice, consider the following. 1. Check credentials. Ensure the advisor has relevant certifications, such as CFP, Certified Financial Planner, or CFA, Chartered Financial Analyst. 2. Experience matters. Look for advisors with experience working with clients with similar needs and goals. 3. Fee transparency. Understand the advisor's fee structure and ensure it aligns with your expectations. 4. Communication style. Ensure the advisor's communication style suits your needs and preferences. 5. Fiduciary duty. Verify. The advisor has a fiduciary duty to act in your best interests. By consulting a financial advisor, you can gain confidence in your financial decisions and create a personalized plan to achieve your goals. Real estate investing involves owning physical property or investing in real estate investment trusts, or REITs, to generate rental income and potentially benefit from property value appreciation. Pros of real estate investing. 1. Rental income. Earn regular income through rental properties. 2. Appreciation. Property values may increase over time. 3. Tax benefits. Deduct mortgage interest, property taxes, and operating expenses. 4. Physical asset. Real estate is a tangible asset that can provide a sense of security. 5. Diversification. Real estate can perform differently than stocks and bonds, offering diversification. Cons of real estate investing. 1. Illiquidity. Properties can take time to sell and convert to cash. 2. High upfront costs. Purchasing properties typically requires significant capital. 3. Maintenance and management. Direct property investment requires hands-on involvement. 4. Market risks. Local market conditions and economic downturns can impact property values. 5. Leverage risks. Using debt to finance properties amplifies potential losses. Types of real estate investments. 1. Direct property investment. Owning physical properties, such as rental homes or commercial buildings. 2. Real estate investment trusts, or REITs, companies that own or finance properties and provide shares to investors. 3. Real estate crowdfunding, platforms that allow individuals to invest in properties or projects. 4. Real estate mutual funds, diversified portfolios of properties or REITs. To mitigate risks, consider 1. Research and due diligence. Thoroughly investigate properties and local markets. 2. Diversification. Spread investments across different property types and locations. 3. Professional management. Hire experienced property managers or invest in REITs. 4. Long-term approach. Real estate investing is often a long-term game. Remember, real estate investing can offer attractive income and appreciation potential, but it's essential to carefully weigh the pros and cons and consider your individual circumstances and goals. Remember, investing is a personal journey. It's essential to assess your individual circumstances and goals before making investment decisions.